That's
Wow.
great advice.
Yeah. Wow.
No, that was really good.
All the contractors too. Get your
No,
quotes.
I agree with you that excuse me. I agree with you on that, George. I've dealt with some crazy situations in the single family realm with my second house
Tell us about it a little bit.
with a crazy contractor, and I didn't do my quotes. I didn't go find multiple contractors. I trusted one individual, and I ended up getting burnt. He did some crappy work and kind of jumped off at the end of it. You know, he left us in shambles near the end,
Wow.
basically incomplete. So no, I definitely agree with you on that, George, where it's find the right contractor, you know, do your due diligence, not just on the numbers, but the people that you're going to be working with, your property management team, your contractors, all of the
Everything going
above.
around in the area. Like, I never even thought to think of jobs coming in. Like, how many jobs are already in the market? What is the like median income of the market? Like all of that. Like it just as soon as you started talking, things just started to go off in my head. Like, oh wow. Like I never thought of the qualitative side of real estate. Always kept it like, all right, this is a numbers game, like any other sales game. Nah, there's a whole different aspect to it, and it goes into the psychology of everything. Yeah. No, I enjoy that. That answer was absolutely phenomenal, and you helped open my eyes. Let me trade it off to one of these guys. I'm sure they have a question.
No, you go.
All right. So basically, George, I'm just wondering too, if someone wanted to go tackle this deal, but they didn't have the money themselves, you know, how would they go about finding the money for this type of deal?
Beautiful question.
Who do they go to? What are the people they partner with? You know, I know this is something that obviously is very heavy on in many mentorships, you know, so how do you go about making this deal actually come to fruition?
So my first question is, how big is the deal? Is it small enough that you could get 2 or 3 big investors, plus yourself and whoever else you need to run the deal? Then maybe you can have everybody be active if you got 5 or less and do a joint venture. I would highly recommend joint ventures. Syndication is great, but not every deal has to be a syndication. If you can save $10,000 and a whole lot of investor relations because everybody's involved, so everybody knows what's going on, then go ahead and pull it down as a joint venture and just bring in some good partners. Now, if you do have to go out and syndicate, then yeah, you need to partner up with somebody who's raised capital before. And that's a huge thing because raising the capital, that's one of the bigger expenses in the GP. So you're going to have to allocate a lot of that GP split to the people who are raising the capital and of course doing other things as well. You can't just raise capital for a deal unless you got your broker dealer's license. So you have to, I think very carefully before you go and want to turn it on or turn it over to a different team and to turn things into a syndication. But if you do have to syndicate, the thing of it is you want to go out there and look early. Best time to look for capital is when you don't need it. So make sure that you do have a good network. Make sure you have that social media presence. Tell your friends, hey, this is what I'm doing right now. And let them know about your other experience. So you did single family or you did some duplexes. Let them know, hey, this is what I've done to prepare myself for taking down larger apartments. And hey, by the way, I've got this partner who has 300 plus units. And so don't worry, you're not just relying on my experience. We're going to be leaning on him heavily throughout the deal. So it's not as if your money is going to be trusted to someone who's completely fresh. So I think that raising capital is something that everybody should do. Not everybody's equally suited to do it, but it's good when everybody in the deal can bring some money in. As important as asset management is, and I think it's very vastly underrated, it's all too often an afterthought. The people who get into the deal are the ones who can bring in enough capital to make the deal happen. And then you just end up with the asset management team that corresponds to who was able to raise the capital. So you definitely are going to put yourself in a better position, whether you can bring 50, 100, or $250,000 to a deal. You're in a much better position if you can bring some capital to each deal.
Absolutely. So let's just say you're a brand new investor and your circle is a little bit limited. You don't have an aunt or uncle who may have, this kind of capital, or, these kind of resources are just limited to, what you've known and been around so far. So to that new investor, where would you say is like the first avenue or maybe like the resource that you would try to branch out to raise this capital and talk to these people?
Well, again, you just have to start, I think, by telling your friends, hey, whatever I was doing before this, whether you're in sales or maybe you're a manager of local restaurant, whatever you do, just say, hey, this is what I'm doing now. And I think that's really the thin edge of the wedge. And you also want to provide education. So regardless of whether you closed multifamily deals before, whether or not you even close single family deals, I would say just get out there and educate. And even if you feel, hey, I can't do that at this point, you can still moderate and you can be a curator of information. You can organize. You could start a meetup and you can invite speakers out to your meetup, or run a podcast is another great example. You can start to ask great questions as a podcaster even before you feel that you're ready to go on the podcasting circuit. So whoever, wherever you are on the continuum of, hey, I have no experience, to, hey, I've done this a few times, it's not my first rodeo, there's certainly something you can do to get your name out there and let people know that this is what you do.
I love that. And I think that speaks true to a lot of the young viewers and myself as well when I was first starting in the industry. I think it's a credibility problem that we all have. You feel like whether one deal is a lot to some people, in your mind, maybe it's not. And that's what sets people, a little hesitant with speaking about their endeavors.
Yeah.
Because I know I was like that. With my first deal, I'm seeing people doing hundreds of units, thousands of units, I'm meeting so many different people. It gives you a sense of an imposter syndrome, but it's something that I feel like you need to just conquer. You need to get over yourself, get over your high horse, and just be proud of who you are, be proud of the situation you're putting yourself into.
Yeah, man.
George, so.
Well, hey, can I jump in there? Because you said you like to hear mindset. And so if you've heard about the gap in the gain, you'll understand that you may look at where you're at and someone else who closed 1,000 units in their lifetime, or maybe their first deal was 300 units. And you may look at that and say, like, wow, I can't do that, because you're looking at the gap. And as long as you look at the gap, you'll never be happy. But if you look at the gain, how far you've come, then you'll always be happy. Because there was a time that you didn't have the education to even know whether or not real estate was for you. There was a time you never had that first deal. There was a time before you had the issues with the contractor, which I hate to say it, but success is a poor teacher. We learn so much more from the difficulties that we surmount. And when you look at how far you've come, then you always have a right to be proud of yourself and repurpose what you have in your past. So I was a tech guy. What does that have to do with real estate? Obviously, there's some data, there's some numbers, but I decided to repurpose myself as the data scientist of real estate, and I'm having fun with that. So wherever you came from, if you're in sales and you're great at dealing with people, or whether you came from a technical background, there's something in that background that's unique, and you'll have a better time speaking to people that have that similar background. But even more importantly, remember, there's nobody in the world that has the right to tell your story but you. And when you look at it like that, you'll realize that you do have a story to tell, and that it's completely unique, and that is your angle. That's your advantage over all other human beings, because nobody has quite your experience, and you'll be able to use that both to your advantage technically as well as in relating to other people.
That's amazing. Beautiful words. Thank you. Thank you for that, George. I just have a question when it comes to the investor side of things. If I wanted to be a lender to you on one of your deals, I wanted to invest with you on one of your deals, what are the returns looking like? Like, what are the general returns that we would be getting as an investor, so that anybody out there that isn't, trying to actively take an approach to real estate, they can at least passively invest with you and us on deals in the future?
Right. So yeah, I'd be careful about conditioning the market, but just to say in general, what I'm seeing in real estate is a lot of these syndications are returning upwards of 6% as a preferred return, sometimes 7 or 8. That's getting a little harder these days. Deals are a little thinner, at least on the underwriting. Of course, if we see those rates come down, some of these deals will hopefully outperform. And it's not uncommon to see 15% IRR. Now, I just went back, I'm writing a book, and took a look at how the S&P performed over the last 20 years. And I know it's in the single digits. I want to say it was something like 7 or 8%. So you can see that if you get into a decent real estate deal, even as a passive investor, there's the likelihood that you can do far better than the S&P and hopefully have far better gains, because although we have seen a 50% drawdown roughly in real estate, maybe not quite as much. We saw certainly a little bit over 50% in the S&P during the global financial crisis. So I think I misspoke there. We didn't see quite nearly. I think it's more like 23% if you're looking at Case-Shiller. But we see some drawdowns from time to time in real estate. You can clearly do much better and have much smoother returns easily.
Fantastic. So aside from the hefty and profitable returns compared to every other industry at the moment, what are some other benefits that, investors get from investing in multifamily deals like this?
Well, I find the most surprising benefit of real estate as a passive investor is you can still benefit from depreciation. You get the tax benefits, some of the tax benefits that you get from actively managing real estate. And if you're a real estate professional, now I'm not a tax professional, you want to go and consult one and make sure that this fits your current situation. But if you are lucky enough to be in a position to be classified as a real estate professional, then even passive losses, which of course, when I talk about losses in real estate, we're talking about actual cash flow, real money in your pocket, while your tax return shows less than that number, or perhaps zero or even negative. So you could very easily, as a passive investor, have money to apply against your income. For example, if you're a realtor, if you run a construction company, or like us, if you happen to be full-time real estate investors. So to me, I think that's just amazing. Without even operating the property, that I can get those same tax benefits.
Absolutely, I agree. That's what I always tell my investors when I'm approaching them about these deals. It's not even the upside for the cash flow or the equity return. It's just that everything that you do work hard for throughout the year, you could possibly write off a big portion of it.
Oof. Yeah, that's huge, man. That is huge.
And that's the biggest thing. I think what I always tell my investors is that I'm here for you. I want to see your money multiply. I want to make you financially free. You've worked so hard your whole life to save up this money, make this money. Now you want to make that money work for you in all aspects. And what are some other avenues besides if you have some money saved up that people can invest in deals like this with?
Well, so I mentioned joint ventures. We just talked about passive investing. Of course, active investing as well. If you're going to go out there and sponsor a deal, you're going to be anywhere on the GP team, even a co-GP, it helps a lot if you're putting your own money. Because if you can't go to people and say, we're putting in at least 10% of the invested capital, and I would say commonly it goes even up to 20%, maybe even more, then people have a right to doubt your deal and ask the question, well, hey, if this is so great, why aren't you putting your money into it?
No, absolutely. I completely get where you're coming from. They always question that. But I think that's why too, on the managing partner side of things, I've seen a lot of syndication teams where they put up their own acquisition fee as some money into the deal.
Yeah, and turn it to the LP side. Yeah,
exactly. And I mean, have you seen that in your business yourself? Have you done that yourself where you've taken some capital from actual closing, or you've put up some capital as an earnest money deposit to kind of solidify the investor's feeling of why don't you have something in the deal?
Mm.
Yeah, that's a great first step too, because when you're talking about different ways you can get involved, now Pace Morby, I love it. He calls this gator lending because you're putting a relatively small amount of money, but you're going to take a giant chunk later on relative to the amount of capital you put in. Yeah, if you can say, hey, look, this is some $5 million deal. I put up $50,000 of risk capital. Maybe that's a small amount of the total capital required, but you're taking an outsized risk during your due diligence period that you might end up with a goose egg. So yeah, huge way to get into it. And for people who do have the financial wherewithal and who have that sort of appetite for risk, if you're willing to put up risk capital, that's a great way to possibly get onto the GP team. If you've been an LP and you say, hey, I really want to get into this in a deeper fashion, then certainly I don't think you're going to hear many no's if you say, hey, I'd love to put up your risk capital for the next deal.
Yeah, absolutely. And for all the private lenders out there too, they could probably invest, not probably, they can invest with their IRA, correct? If they don't have the direct cash, they would be able to also take out a HELOC on their home, things of that nature, to also potentially get in on the LP side of things on a multifamily deal. You don't have to just have a lot of saved up money. You could leverage,
exactly.
the equity you have.
That's awesome. I don't know so much about the HELOC. That can be kind of dangerous, but unless you have other types of reserves. But a self-directed IRA can be great. A great way to get started. If you got a 401k, if you don't roll it over, I would recommend see if you can turn that into a solo 401, because that will save you in terms of taxation. It's even better than a self-directed IRA.
That's good to know. I'm definitely going to take a note for that. I didn't know that.
Yeah. I'm like, where's my notepad, man? Let me write that down.
I didn't know that at all. That's actually dope. That's real dope.
Okay.
Now, George, I think we have like one more question for you. David, did you want to ask him?
Well, yeah, no. So George, so I kind of just wanted to also ask, like the future, right? So what do you see for the next 5 years, like trending wise for multifamily? You think just this is going into the right direction? Just keep, I guess searching and going for the bigger deals, or just like you said, go incremental, or like just basically like what kind of trends do you see within these next few years?
Well, the first trend I see is that we're hugely underbuilt, and that's not going to change in the next 5 years. So 100%, I will say 5 years from now, we are still underbuilt. In the meantime, I think rates are going to go down. That's going to be a huge tailwind to real estate, and I think prices are going to increase rapidly. Now, as for myself and where I see my own growth, I have done a lot of mid-sized deals, and I think that's a great place to be for me right now, because whereas I have been a smaller player in some very large deals before we saw the economic turmoil, I love that seller financing. I like to play in an area where I feel that I have a great deal of tailwinds behind me and a lot of margin of safety, right? If you're buying where you've got your rents are already below market, that's huge. That's a huge margin of safety right there. Having some capital on the side, some reserves, is also huge. And knowing that you have non-recourse debt whenever possible, which is great with these smaller deals. Now, let me tell you one other thing. I want to make sure that you are able to exit nicely in these next 5 years. So if you do get one of these smaller deals, you need to either make sure that you got your numbers buttoned down and you know exactly how it cash flows so that you don't care that you have recourse debt, or you want to make sure you can get that loan size up to over $1 million so that you can get that agency loan and you can sleep well at night knowing that it is non-recourse when you refinance.
Absolutely.
Wow. That's amazing, man. We appreciate every bit of advice you've been able to give us throughout this show, man. It has been nothing but gold, absolute gems. So we just, like I said, want to thank you once again, George, for joining us and being able to speak and give your insight on everything multifamily. Everybody, this has been the Checkmate Real Estate Podcast.
Hold on, wait. Before you end it, George, where can we find you?
Yeah, where can we find you? What's your social media?
Oh, sorry.
And
my bad.
George.
That's perfect, guys. Thank you so much. So yeah, come find me on LinkedIn. I'm there all the time, it seems. George Roberts III, PhD. And you can also find me elsewhere on the internet as the Data Scientist of Real Estate on YouTube. But again, if you want to reach out to me, best way to do that is through LinkedIn. And I want to say thank you, gentlemen, so much. Anthony, David, Asia, this has been a great interview. You guys are going places. Thank you.
Thank you so much, George. I just wanted to ask you one last thing. What is your buying criteria so that anybody out there who wants to partner with you can, send you over some deals and hopefully, make some business and make some money together and make some relationships?
Sure. In general, I'd look for about 20 units and up. I like those deal sizes where we can get into the agency debt. So if the loan size is over $1 million, that's a huge plus. I like the middle latitudes of the country. I'm really liking Kentucky and particularly East Tennessee. I think these are areas that are really going to move forward. I love Cincinnati, but I am pretty broad in my criteria. If you're not in one of the markets I'm already operating in, because I've also got property in Central Florida, it doesn't mean we can't do it, but we're going to have boots on the ground. So make sure that you have somebody on the ground, or come to me and we'll see if somebody in my network can come help us run the deal. But I would say 20 units and up, generally $1 million loan size or more. And I like areas that are not rent constrained. So places where you're nowhere near 30% rent as compared to income.
Okay, perfect. Well, thank you, George.
Awesome. Thank you, man.
Yeah, man. Appreciate you so much.
And we're going to be having you on another episode in the near future.
I would love that, guys.
Yes, hopefully we have a few deals done together between time,
Yeah, we're working on that Miami one. We just got sent the financials, so I'll send those over to you. And, your team can underwrite them, and we'll underwrite them as well.
Yeah, you got it. Like I said, I'm totally open. Love working with different groups. It's always a learning experience. It's always valuable to spend time with people.
Perfect. Thank you so much, George, and we'll be speaking soon.
That was great.
Cool. All right.
Yo, I ain't gonna lie, I learned a lot off of George.
Yeah, holy shit. Yeah, because a lot of things we haven't really dove too crazy into the multifamily realm of everything. So that's why we've been talking a lot of seller finance, a lot of residential stuff, a lot of different, sub 2 and executory contract. We've been talking about all that. But for him to really give us a full kind of from the LP side, sponsor side, hey,
GP, he's
everything, of course, but that's the point, you get on both sides of the deal and you make it happen, man. So it was great to get some true insight from his perspective and not just,
listening to us talk.
Yeah, exactly. I get tired of myself, damn it.
Shit. I ain't gonna lie, it's watching Pace Morby videos and all of the other real estate investment videos and stuff like that, and learning, it's so different when you actually have somebody who's skin in the game, have personal conversation, really live questions and stuff like that. That is dope. Yo, you guys, leave your comments, leave all types of comments, because we will ask these questions to the people that we have on there. Do not forget to do that.
Yes.
Yeah. We'll be having a lot more people on very, very soon.
So subscribe to the YouTube, comments, everything, man. Send us some hate mail, some love mail. Who cares? Just send us something, please, Lord Jesus.
Say fuck you.
I'll
write a letter back, say fuck you too.
Yeah, that's it, man. So everybody, this has been the Checkmate Real Estate Podcast, brought to you by CG Studios, the multimedia company that encourages you to create, entice, and live nice. And WPKN 89.5 FM. My name is David Smith.
And I'm Anthony Ramo.
And I'm Biz the manager.
You forget yourself, bro. At this point, you forget yourself.
You forget yourself. I really be trying. I got a point. I'm pointing, man.
Nah, that's a fact.
The camera knows. The people know. You guys are with me.
I definitely be forgetting. I'm sorry.
We love you. We love you.
Yes. So